Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is a cannabis business podcast. Forbes asks a really interesting question. Is it too late for mom and pop shop operators to get into cannabis? 5 years ago, I thought I was too late getting involved late 2014, early 2015. I thought that opportunities were done. And that was still when Washington State was medical. We didn't have recreation until the spring of 2016. And yet there was a lot of people who felt like they were late to the game. So I definitely think depending on where you're at, there's opportunity. There's people who have left Washington State for Oklahoma as of recently. Chef Jeremy Cooper, shout out to you, still making some fantastic edibles down there. I wish you all the best of luck. And so I know that people have left for Texas to do CBD. There's opportunities all over the place. So I personally don't believe it's too late, but if you don't know what you're doing, you have years to learn, and there's just not that much time. So if you know what you're doing, jump in. And so if you're already a chef, do CBD stuff, do THC. But I think in terms of getting on board and learning by trial and error, that time is over. There's no more time to lose out. I know of investors that will drop $150,000 on a license, and then lack of due diligence or oversight or management has caused them to lose all of it. So they still have a license, but there's nothing left. There's no assets. There's no grow. There's no facility. And so even successful people who know what they're doing still lose out. And there's multiple examples of that I won't get into. But in terms of having the opportunity, I would say yes, but caveat emptor, it's buyer beware. Know what you're doing or just get out. And that goes with stock investing too. If you think you're just going to throw money at the stock market, it's going to go up for no reason, then you don't understand the market. There's a dead cat bounce right now where even a dead cat can go up and bounce up. Quantitative easing has thrown so much money in the market. You're going to see people start putting money into cannabis as other investment vehicles start to lose their luster, lose their appeal. And we're already starting to see that. The valuation investors can't find anything. And so there's hedge funds that are closing. Bill Gross, the bond king, retired. And so just wait for that. We haven't seen a debt market correction in over 4 decades. I've never seen it in my lifetime. I doubt many people even remember what it looked like when the bond market had a correction. And so invest wisely. Here's a story about 2 entrepreneurs who founded a medical dispensary in Denver with $4,000 and half a pound of cannabis. They started Denver Relief and went on to become one of the country's most well-known dispensaries. So their experience wasn't unique either. Stories like this abound from the industry's early days when all ambitious entrepreneurs needed was just a small amount of startup capital and some grit to get their business off the ground. But the barriers to entry today with the cannabis market far exceed what most mom and pop cannabis operators would have prepared and capitalized to undertake. So in today's world, that $4,000 wouldn't even cover the necessary license applications, and in any market, let alone be enough to hire the army of attorneys, lobbyists, and architects, and security experts and operational advisors necessary to license, plan, build, and operate a store. Nor would it be enough to cover the 1 to 3 years of carrying costs for operating in slow-growing markets or in a highly competitive market with razor-thin margins. And that's going to show in every single state that goes from medical to recreation. You're going to have a majority of people who come in because you don't have to have security cameras. You don't have to follow by certain regulations. And so the majority, 3/4 probably, will not transition over because of the expenses. They just realize that their location isn't good enough, the product quality, service, whatever. It's going to be a matter of convenience. And right now people don't understand that. It truly will be a matter of convenience. And you can see that as joints being the #1 product sold in a lot of these states. And so if you don't have a convenient location, there's a coffee company that thought that they could open up outside of Seattle, And when I was talking with them, they thought people would buy coffee where it was close to their house on the way to work. But a matter of convenience is their location downtown Seattle does more business than their other locations combined. And that's because it's a matter of convenience. So I think whether if it's cannabis or coffee, that commodity is a matter of convenience, and people are going to go where they can, and there is no loyalty. So what are mom and pop operators to do? So most of the answer comes down to finding access to capital that can get an operator over that initial hurdle, get stores opened up, and hopefully thrive. But just like any entrepreneur would do. So in the cannabis industry, banks won't lend money, institutional capital is still on the sidelines, and angel investors are more likely to limit their capital investment to more experienced operators who carry less risk of operational failure. So as outlined in the previous column, there's traditional lending sources that have difficulty in accessing capital and can hamstring the local entrepreneurs who want to find themselves competing against better capitalized multi-state operators, or MSOs. So for those who do manage to find some kind of funding sources, they're often at a competitive disadvantage to their operators, since they find themselves competing with those MSOs, which by now can draw a deep well of operating experience and talent. So it's becoming the cannabis equivalent of an independent operating, the Betty Burger joint in a crowded market where they must compete with Five Guys, Shake Shack, In-N-Out Burger, and McDonald's. So it's a small operator that may be able to raise a capital to open their stores, but what the chances are, they'll be ultimately succeeding when competing with better capitalized, more experienced operators. So there's one reliable source of support in the cannabis industry. Those same multi-state operators have large valuations, ample balance sheet, and they're looking for opportunities to proliferate their brands in nascent markets and demonstrate growth to their investors. So by partnering with the multi-state operator, it provides several benefits for the mom and pops in the cannabis world. First, they provide access to immediate capital for the $200,000 to $1.5 million of startup costs that a dispensary would need in order to get most of that significant market share. So they provide access to the capital required to obtain and carry the real estate for the operations, anywhere from monthly rent to a multi-million-dollar purchase. And again, banks aren't offering mortgages for cannabis operations. So next, the multi-state operators provide battle-tested operating platforms that allow entrepreneurial partners to benefit from the years of research and development that have gone into things like securing zoning permits, designing security systems, refining point-of-sale systems, developing HR policies, getting hiring right, securing payroll services, all of those things. So throughout the management services agreements with these multi-state operators, you're going to have local entrepreneurs who benefit economically from the economies of scale that come from a multi-state operator buying power for share services among operations they support. Most of the people in Washington state are not making money. It's funny how many people think that there's cash being thrown everywhere and everybody's a millionaire, and it's just not the case. I really think that these multi-state operators are going to provide for more of a turnkey franchise opportunity. Hopefully they've done the research with all of the data aggregation opportunities to find out optimized inventory, flavor profiles based on zip code, and just the right products for the right place, and avoid a ton of headache. They also offer branding and marketing support that position an operation to take advantage of the recognized branding momentum and deploy it in a new market so they can successfully compete against other stores that potentially acquire marketing and branding acumen through their own MSO relationships. There's a lot of ego in this industry, and people think that they can just open a place wherever they want and they will come. And it's just not how it works. So brands are starting to become more about the reputation or the expectation rather than with the flavor. I would argue that people don't like Starbucks all that much, but if they can consistently get burnt coffee and know what they're getting, they'll put up with that rather than having to guess each time what's going to happen. So an MSO isn't necessarily the right path for every cannabis entrepreneur, but for those who are interested in exchanging some of the economics to gain support on the operational side while maintaining leadership of the growth of their own operation, parting with the multi-state operator could be a good fit. So it's worth noting, however, that all regulators see that in a different way. So for example, in Washington state, being an outside investor is limited. And so you have to have a certain amount of local residents versus outside investors, and everybody has to go through a whole vetting process. And oftentimes, if you have a felony or there's certain things on your record, then you can't be approved. So it's not all that easy. But given the realities of the cannabis business landscape, especially with the lack of access to institutional capital and extreme difficulty in raising money from angel and institutional investors, we need to rethink how we define success for smaller organizations in the space. If our only definition for success is for a local operator to successfully compete against the larger multi-state companies, then we're setting ourselves and these operators up for failure. In the current regulatory climate, we have to expand our definition of success to include having to create an avenue for these operators to meaningfully participate in the industry, whether by hitching their wagon to a larger player and reaping the upside rewards, or becoming a multimillionaire through an exit. None of this is to argue that states should not create avenues for locals, mom and pop operators, and social equity applicants to win and hold licenses. In fact, I would argue strongly that they should, as they ensure less capitalized and underrepresented populations can gain a meaningful ownership stake in the industry, no matter the path they take to operate their licenses. And with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge, and I'm out.